There comes a point in every successful business owner's lifetime when the questions they start asking themselves need to start changing. In the beginning, the questions are fairly simple. How do I make money? How do I survive? After you get over that survival hump, then the questions become, how do I scale? How do I maintain? How do I grow? But eventually, if the business becomes successful, a more nuanced question arises. It's simpler in execution, but more complex in nature. What do I do with the capital and the success that I've created? Sounds like a great problem to have. It's a first world problem to be sure, but it's still a problem. In fact, it may be one of the more important and crucial questions a business owner will have to ask themselves. Because once you have idle corporate surplus, some investments in a securities portfolio, real estate, retained earnings, family obligations, maybe you've got holding companies or even a family trust. The issue is no longer what kind of rate of return I can earn on all my assets. The question then moves into, is my capital structured intelligently? A lot of business owners are already managing a lot of investment wealth and competent advisors to help them along. They may already have real estate holdings. They may already have professionals on board, lawyers, accountants, financial planners. They may already be doing well by any normal standard. And yet, they still feel this quiet uncertainty. They know they have money. They know they have opportunity. They are not quite sure if their money is sitting in the right place or being taxed in the right way, available or liquid at the right time, or serving the right purpose. And that's the question and the conversation I think more business owners need to have. Not what product should I buy or what has the highest return. A better question is, what am I trying to accomplish and what job is my capital supposed to perform? Simply put, and to channel Simon Sinek's Start With Why, we have to start with the why of the capital before we would decide what to do with it. And that one question changes everything, because all the money in our companies isn't supposed to perform the same job. Some capital is working capital. Some capital is supposed to be stored in a war chest for emergencies. And other money is set aside for opportunities to grow or invest. Other capital is really earmarked for retirement, and still more capital is earmarked for wealth transfer to my beneficiaries. Some capital should remain protected and other capital should remain liquid. The mistake is that we treat capital as serving the same purpose. And that's where conventional financial advice can start to seem a bit narrow. And it's not a slight against conventional advice or conventional advisors. The financial industry is full of great advisors doing great work for great people. But the financial industry has also trained advisors and clients to think about choices in terms of product comparisons. Should I choose mutual fund A or mutual fund B? Should I choose this rate of return or that rate of return? Should I go with advisor A's portfolio or advisor's B portfolio? But a business owner's financial life is not reduced to a product shelf. It's a system, and systems require design. For example, a hammer as a tool isn't any better than a drill or any better than a wrench. It performs a different job than a drill or a wrench does. And the value of the tool depends on the goals you're trying to accomplish. If you're trying to hang a picture in your living room, a skill saw is not going to be very helpful. On the other hand, if you're trying to refurbish and replace your bathroom, while a wrench is going to be helpful at some point, you can't do the entire job with just one tool. And financial tools don't act very much differently than a construction tool does. It all performs a specific task to perform a specific objective. For example, investments have a specific function and design. They are designed to generate a rate of return over the long term. If your objective is to grow your capital, then investments are important to include in your overall strategy. And that means public securities, private securities, real estate mortgage fund, private businesses, they all have a place. And just like that hammer, investments are not designed to solve every problem. For example, an investment portfolio does serve a growth need, but it doesn't always provide a liquidity need. It may not solve tax drag in a company, and quite honestly, it may even create a worse tax situation. It may not protect you from forced liquidation, bad timing, or tax friction. And again, it doesn't make investments bad, it just means that they don't serve all purposes. Again, I think this is where a properly structured tax-exempt insurance contract is often misunderstood. When people hear the phrase whole life insurance, oftentimes people become emotional, confused, and defensive. They'll say, I don't need life insurance, or my children already have enough. They'll ask questions like, aren't returns better in the financial markets? Or suggest that my spouse is just going to be fine. And those are all very fair and valid comments, but all of them miss the point. For many successful business owners, the primary reason to consider a tax-exempt insurance contract has actually little to do with providing an extra death benefit to cover risk. It's also because they're not trying to play the comparison game with investments that are completely different financial instruments. A properly designed tax-exempt insurance contract is more likely to be used by business owners as a control and capital tool rather than to provide a necessary death benefit to cover paying off a mortgage or providing income replacement. It's also part of a broader strategy used by many business owners for liquidity, collateral access, cash flow management, and long-term estate planning. It can also allow the accumulation of corporate capital on a tax-exempt basis, provided the contract stays exempt within the rules. In reality, it's options. It creates options for business owners who want the control of their money, but also having the collateral access of liquidity, rather than treat their corporate income the same as their interest income or investment returns. That does not mean that this is some magical utopia that's somehow compliant and suitable for everybody that wants to get a policy. It also doesn't mean that carte blanche policy design doesn't matter. In fact, policy design matters greatly. But what it does mean is that the conversation between advisor and client needs to elevate beyond the simple comparative analysis between an insurance policy and an investment portfolio. If you want to generate a return and that's it, you should invest. If you're looking for a strategy that includes capital control, liquidity, and tax-aware planning, then perhaps a properly designed tax-exempt insurance contract should be dedicated for a portion of your assets. I want you to think about a business owner who's accumulated some retained earnings in his corporation. Perhaps he has thousands, tens of thousands, hundreds of thousands, or even millions of dollars accumulated and trapped inside that company. He does not necessarily need the money today and is willing to leave it alone and let it accumulate. On one hand, if he decides to pay himself a taxable dividend, he pays rates of tax at his high marginal tax rates. If he leaves it in cash or invests for income, then the high punitive tax rates in corporations would apply, and inflation is going to eat the rest. If he locks it into the wrong structure, he loses the liquidity of that money. Clients with that level of complexity are now asking what to do. And suddenly they're getting all sorts of well-intentioned advice from strangers on the internet. Maybe some of it should stay liquid in cash. Maybe some of it should be invested for the long term. Maybe some of it should be used to buy an individual pension plan. Maybe some of it needs to be included in trust planning or a different corporate structure. It's not necessarily that any of these answers are good or bad or right or wrong. It's just that the questions are being asked in the wrong order. You can't ask what product is the right solution without asking what's the right strategy and what instrument gets you the strategy outcomes that you're looking for. Just like that bathroom renovation, you don't know what tool you need until you first find out what the objective is. And this is especially true because the Income Tax Act doesn't treat all income in the same manner. Interest, dividends, capital gain, insurance proceeds can all be treated very differently under the Income Tax Act. A business owner doesn't need to become a tax expert, but they do have to have a basic understanding of the tax implications of the decisions that they're making. Sometimes the difference between a mediocre financial outcome and a great financial outcome isn't the financial instrument that's selected, but rather the whole strategy that the investment serves. That's why the product-first conversation is so limiting. A product-first advisor says, what product do you want? But a planning first advisor says, what solution are we trying to create for a problem that you may not even know exists? These are very different conversations with very different outcomes. So in my view, when a business owner asks the question, should I invest or should I buy insurance? The scope of this question is too narrow. A better question is, this is my problem, and would this product help solve that problem? The question on whether a specific financial product is good or bad or pragmatically necessary is not about the features and benefits of the product itself, but rather what the goals and objectives are that the instrument is trying to help accomplish within the broader financial ecosystem. And in order to execute strategies properly, a poorly crafted product is going to create frustration, where a great designed product is going to help create flexibility and control. And that's why conversations about financial products cannot just be reduced down to a spreadsheet. That comparative analysis may be useful in the narrow view, but it can also mislead people by suggesting that two separate tools can create the same result or function. They do not. An investment portfolio is designed to pursue returns. A properly designed tax-exempt insurance contract is designed to create a different utility with your money. Both can be useful, and neither one replaces the other. The question is more about how to fit them together synergistically. And it's a conversation more business owners need to have before deploying their capital blindly. Because once a business owner accumulates a meaningful amount of capital, it's not about just the loss of capital, it's about the misallocation of it. And that is the shift I'm talking about, from product to purpose, from what should I buy to what am I trying to build. And that's why when a client starts comparing two different financial products, I'm usually trying to reset the conversation. I'm more interested in asking what dollars should be invested and what dollars should remain liquid. Which dollars should be structured for tax efficiency, and what dollars need to remain available for collateralization. Once you start asking questions like those, the conversation typically becomes a lot more fruitful for the client. So whether you're a long-term successful business owner with a lot of corporate retained earnings sitting in a holding company or an operating company, or whether you're a new entrepreneur but successful and accumulating wealth quickly, you should ask yourself the following question. Is my capital being structured intentionally? Because if you've only accumulated it by happenstance, that still proves you've done something. But if you've structured your capital, then you're thinking more long term. And to a certain degree, the real role of financial planning is to assign the right amount of capital to perform the right job using the right financial product to achieve the right objectives. And that's about moving clients from good to great, from existing to having strategy. Look, the goal is not to own more financial products. The goal is to have better structure. And once you start getting that right, your capital moves from being idle to being intentional, and your strategy can elevate your overall objectives. If you found this video to be helpful in your discovery or journey of financial literacy, economics, politics, history, or philosophy, make sure you like, subscribe, and hit that notification bell for upcoming videos.